Advanced Financial Modeling, Topic 11, Cost of Capital and Real Options. References from Benenga are Chapter 3, WACC, and Chapter 19, Real Options. Learning objective number 1, we're going to understand cost of capital and weighted average cost of capital, WACC. So cost of capital refers to the annualized rate of return required by a firm's debt and equity holders for accepting the firm's business risk and financial risk. So the term, when I refer to cost of capital, I'll sometimes refer to it as required return, expected return, cost of capital, and I'll be using those synonymously. So you can think of the cost of capital as the firm's cost of funding and is used as the NPV discount rate, the IRR minimal hurdle rate, and the discount rate to value stocks. And the interpretation is that in NPV and IRR is that if the firm's cost of capital is, say, 10%, in other words, it costs them 10% to acquire funds, then its projects must deliver more than a 10% return to create value. And that's why you use it as the NPV discount rate and the IRR hurdle rate, that minimum rate for new projects. When we calculate the cost of capital, we usually calculate the weighted average cost of capital. Weighted average cost of capital, otherwise known as WACC, is the firm's cost of capital that accounts for both debt and equity funding. When we talk about debt funding, that's the funding cost of the company's debt holders, and you can think of that as either loans or bonds. And we talk about that cost of debt is either the KD or RD. So when we use, I usually use KD, K meaning the rate of return, or other textbooks use RD. Remember that interest payments paid to bond and loan holders are tax deductible for the company. Therefore, any rate of return we pay on the debt through interest payments is tax deductible. So we say the cost is that cost of debt times 1 minus the corporate tax rate. Now, equity funding. All right, so funding that comes from owners is called the cost of equity. Again, it would be KE or RE. Now, when do the owners actually provide funding? Well, during stock issuance, either an IPO, initial public offering, or a seasoned offering. Once a company's been around for a while, it's already had an IPO, it needs to issue more stock for more funding. That's called a seasoned equity offering. Also, whenever a company retains earnings, that is an equity investment. It's the shareholders are the owners of the firm. They have a claim on profits. If profits are not paid out as a dividend, that is funding provided back to the corporation. So both seasoned equity offerings, initial public offerings, and retained earnings are sources of funding from the owners. Dividends are not tax deductible, therefore we're not going to adjust them for the tax rate. We're going to show you later that to get the cost of equity is not an easy thing. We're going to need a model called CAPM. And here's our calculation for the cost of capital for a firm. It's called the weighted average cost of capital, otherwise known as just WACC. And you can see what it is. It's the cost of equity times the equity percent plus the cost after-tax cost of debt times the debt percent. So let's take a look at those components. That cost of equity is going to be whatever rate of return that our shareholders demand. We're going to need a model for that called CAPM. The equity percent is the share of total funding provided by equity. That's the total value of equity. That's the market value of equity over the market value of equity over the value of debt. So E over E plus D is the percentage of equity financing in the firm. Then we take the after-tax cost of debt. I'll show you some different ways later to get cost of debt. You could look at the yield on your bonds. You can look at the interest payments being paid. You can look at the stated rate on a loan. So we're going to get the cost of debt several different ways. Multiply that times 1 minus the tax rate to get the after-tax cost of debt. And then we multiply that times the share of debt financing in the firm, which is the total value of debt over E plus D. One note I'm going to make is often we use net debt instead of debt, and that is debt minus cash, and we'll explain that later. All right, so in this topic, we just gave you a concept of cost of capital and the weighted average cost of capital. And the next one, we'll actually estimate the cost of capital for equity using CAPM.